Amit Sachdeva is with us. He's head of India Equity Strategy at HSBC. Amit, good to have you back in the program. It's been a while. Thanks very much for your time. Prashant this side. Amit, your view seems to be that maybe a little bit of consolidation, but nothing large in terms of a pullback. This is not 2018, I think, as you put it. Just explain that view, and but you're still kind of leaning more towards large caps. So just kind of put that in context for us.
Yeah, thanks, Prashant. Good morning, everyone. Thank you for having me here. See, I think the main point is that we have to go back and analyze India's own cycles. There's a lot of wisdom buried there. So let me bring out very crisp one on mid caps and small caps. First of all, mid caps and small caps are symptoms of India's bull runs. A momentum once set doesn't go away that easily. And what happens is that typically that run over market run is about 1.4x. We have been flagging for a while that that run was already around 2x, which means that there was a lot of froth in mid and small caps. And if you look at last 4 years, they have been a consistent outperformance. And if you go back into the history, you realize when that happens, you are going towards a year where there will be negative or muted returns, right? Now, when the last month's sell-off has happened in small and mid caps, it triggers an alarm. And what that alarm is, are we looking for much deeper cuts? Because small caps corrected 8% and mid caps corrected 4%, and the momentum seems precarious when you ignore a day such as today, for example, right? And if you look at that momentum, it triggers and a question as well whether we are looking at 2008 cycle where mid caps and small caps corrected 30%. So question is, are we in that cycle? My short answer to that is no. We are not looking at 20 to 30% aggregate correction because the context is very, very favorable and very different from 2018. But does that mean mid caps and small cap will do well from here? My answer is also we need to be very cautious. The returns could be an aggregate level, would be at the best lackluster or muted. But having said that, market would be intermittent risk on and risk off. Corrections will also present buying opportunities and mid caps. So we must exploit that as well. But on aggregate basis, my tilt would be towards larger caps have lagged last year. Earning growth looks good. Indian market context seems very good overall. So we see an overall positive context, but tilting towards the larger cap, but mid caps and small caps would have its own share of volatility. Let's to summarize that bit here.
Okay, so mid caps and small caps will continue to have its own share of volatility. Got it. Amit, thanks a lot for joining in. So, how do you approach the markets now? You've told us about the backdrop, but from here on, what's the best way to approach the markets? Do you raise your cash levels? Do you churn out of mid and small caps and into large caps? Do you move to other asset classes? Over the next 12 months, what's the advice?
Okay, now that's a great question, Sonia. Let me just break it down into two parts. Okay. First of all, we need to have a view how risk tolerant the market will be. Right? And second, how the earnings and things will shape up, etc. So my sense is that if the US bond yields are seen to be correcting, because the key factor for India also would be external, not just internal, right? So if US bond yields, which are expected to be corrected and expected to be coming down, if it is going in the right trajectory, I see a return of a big risk on in India. If risk on happens, you could expect major bounces in corrected names as well, which includes mid and small caps as well. But even with the moderate expectations there, my sense is that earning outlook for India is good. So there'll be at least a decent year, if not a big risk on. That's one. Now, within that context, we divide sectors into three larger buckets, right? One bucket is where things have already looking very precarious from investor sentiment point of view, and business dynamics also negative. We call it a risk-on bucket, right? So that bucket outperforms a lot when market is willing to take risk with a two-year view. That could happen predominantly. So one must choose some ideas from there. And in our last report, we highlighted that banks have slipped into that basket a little bit. So there are some interesting sectors are parking there. Right? But at the same time, we also must look at momentum. Some earning outlooks are very good, and also the stock returns are very good. But momentum can carry on in this market as well. So we need to blend momentum as well. And then there are some sectors which are very well positioned. from a long and short term point of view as well. So we need to take a barbell kind of approach and blend all these three things together to navigate this year. I don't know whether that answered precisely the question because I can't talk specific here, but I can sort of give more guidance on sector as such. But our view is that we should expect bouts of consolidations and bouts of strong rebounds in this year as the earnings shape up, whether any downgrade risk are building up, etc. But on an average, I expect a decent 2024. It is not going to be a negative year.
All right. Hi, Amit. Good morning. And, good to hear your thoughts. For one, our retail audience will be breathing a sigh of relief that you're saying 2024 is very different from 2018 because that was a very, very painful period for the broader markets. And this time around, you believe things are different. Since you want to talk a lot about sectors, let's talk about the paints industry. You have a new player that's come in there, and there's a probability of some disruption. As to his pricing, they have positioned it lower, and they're giving more volumes as well out to the dealers. But one of the top ideas that you'll have is Asian Paints. As a consumer, maybe I still tilt towards the Asian Paints, just maybe. But from a stock perspective, given that there is going to be some enhanced competition, how do you approach the space?
For right or wrong purposes, we can't discuss individual stocks here, so you have to excuse me there. But I can broadly say that what our view has been that price wars, sustainable price wars are unlikely. There's a little less space there in the space, but I think it's more around how the conduct shape us. Our view is that it's likely to be rational. The reason for putting that is market is obviously bearish, stocks have corrected on these concerns, but largely we believe that rationality will prevail sooner and then market will discount that. That's the reason for taking contrarian view in that space there. But I'll leave it at that. We can't discuss very specific context here.
Then.
But let me just give you some perspective on 2018, right? Because what should give you confidence that we are not 2018, right? Number one, 2018 saw a broader market sell-off of 7%. That was a very bad. And then we have IL&FS crisis unfolding that year. We had GDP growth, which was 3.9. We had a US tightening cycle happening. And we had also earning downgrade. Earning expectation that year was 22. Fell down to, as the year ended, was like single digits. So whatever could go wrong in that year was going wrong. And then mid-cap and small cap, which had a massive run of 4 years, corrected 20 to 30%, 27% mid-caps and 30% small cap. But contrast to 2018, we are in a much stronger year. Macro is strong, earning outlook is very good, not unrealistically high. We are looking at a US softening cycle, not tightening cycle. We don't have any major, crisis in the making as such, which we saw that year perhaps. And valuations have corrected a little bit. So I would say some breather from there. So we are not looking at that precarious a year. But given the valuation, given the incessant run that has happened last year, we also must build in some caution. We cannot sort of just take a view that, okay, we have to build caution. We have to not pay for excessiveness. We have to avoid paying for excessive valuation or where there's a lot of hope trade is happening. So one must balance that view. I would leave that. I would not worry about 2018 situation prevailing, but also caution that buying rationality is key this year because we should not forget China has performed a lot, right? We are looking at years of performance. We need to balance those risks.
Take that point. No, absolutely. Take that point. By the way, I just want to highlight these names, right? Look at CG Power. CG Power was also our momentumizer name this morning. 7% on CG Power. And this after CG Power went up about 5% yesterday. Right, so that's the CG Power now is the largest volume-led gainer across the board. I mean, if you flip that and look at the volumes compared to the average, you'll see what I'm talking about. And the number 2, number 3 big volume-led gainers are PFC and REC, each of which is up 4.5%. So this is, I mean, these names PFC, REC are kind of reminiscent of just strong momentum, if not many other things as well. So just one aspect of it. Triveni Turbines moved up sharply yesterday. That's following up with a sharp gain, about 6.5% there. And something like a Sterling Wilson Solar, 5%. So that's also corrected quite a bit. 491 on that name coming through. Action Construction Equipment, Gensol. These are all kind of coming up. Inox Wind, names which were not there at the open. And of course, something like a Graphite India and HEG two other names which are up 5% each this morning. So, broader market doing sort of very well and kind of broadening out really in that sense. Amit, just your view on, these new business opportunities, right? So, for example, I know you can't talk about specific stocks, but CG Power making a foray and investing into this conductor chip packaging segment. One of the sort of big players who've announced investments, and I guess many others will follow. Just your thoughts, and which are the areas, these new segments that you're bullish on, where you think there is an opportunity to make money as minority shareholders?
So look, what happens is that, there are two views. Prashant is the right question, and one can obviously can't tell specific into anything. So what I can simply say is that, what does it tell you? When you look at these names, it tells you that market is willing to look at decadal opportunities. Market is willing to take risk on something which is longer term themes, which is still emerging, may not have anything in the next 2 years, but market is willing to bet on what players could benefit from a larger trend. So that tells you that when we're looking at India is being looked at as not a tactical, but a large structural decadal run as well. That signals that market is willing to tolerate some risk in the short run and be willing to place bets on longer term themes as well. So that gives you some amount of at least confidence that the structural duration of India is seen as a very long one. And that's the reason some themes that come and go and will play out like that. It's very difficult to take, some sort of, thematic view every day on that. But what I would say is that, anything that looks long term, where the business models are formidable, market would place intermittently, long cycle view on those. I will leave it at that, to be honest.
Okay. I also wanted to talk about the consumption space, right? So I noticed in your buy ideas, you have Avenue Supermarts as one of the stocks. And this morning, in fact, Avenue Supermarts is at a fresh high. CLSA has spoken about how there is a $500 billion addressable market, out of which only 5% of the market is organized. So do you see the scope here, despite the kind of, steep valuations that some of these companies are sitting on?
Sonia, I'll just talk in general because there's stock I cover as well. As I said, that we can't talk about stocks. What I would say is that why we have chosen such names is one, we believe there's a long-term opportunity. But stock is also corrected for one of the two reasons, and there could be many such stocks, right? And risk reward tends to become favorable. And one has to look at such ideas in this market where things have bottomed out and market is willing to take risk for 1 year. So our view was that wherever earning outlook seems to be bottoming out and turning around, those ideas can work as well. I'm not specifically naming Avenue, but all I'm trying to say in general, that's a larger theme we have played there. A structurally winning business model, bottomed out, and could look at uptick in, for example, growth or margins or whatever, based on certain theme that we have.
Okay, all right. We will let you go on that note. Thank you for joining in and taking the time out for us on the channel today. Well, that is the word coming in on the market.